Reassessment does not refer to changes resulting from a modification to the terms of the contract. Reassessment is rather about assessing the timing, amount, and number of payments which are expected to be made to the lessor in the light of original terms of the contract. At the end of the reporting period, however, the estimate of those expected variable lease payments might change because of the new market information about the rates prevailing in the market. This update in the amount expected to be paid is not a result of modification in the original terms. Rather, it's rooted in how the original terms were articulated, hence the reassessment. Whenever we talk about reassessment in accordance with IFRS 16, always expect an adjustment to the carrying value of lease liability with a corresponding effect in right of use asset, unless the right of use asset has already been reduced to zero, in which case any further reduction in the lease liability would be recognized in profit or loss. IFRS 16 makes a very important distinction with regard to how exactly the amount of such adjustment arising out of reassessment should be computed. In view of IFRS 16, there are two kinds of reassessments. We can label them as Type 1 and Type 2. Type 1 reassessment is where there is a change in assessed future lease payments resulting from a change in an index or a rate used to determine those payments, as we discussed in our example. Type 1 reassessment also include, however, a revision in the amounts expected to be paid under a residual value guarantee. In short, Type 1 reassessment is about change in the expected amounts of future lease payments. If, in your case, lease concessions stem from contractual terms which linked your lease payments to an index or rate and which fell drastically due to COVID-19 pandemic, hence dropping your lease payments, you should treat such concessions as a Type 1 reassessment. Unless there is also an element of Type 2 reassessment or modification, as we will soon discuss. The accounting treatment in case of Type 1 reassessment would be that the lessee would remeasure the lease liability by discounting the revised lease payments using the original discount rate. If this decreases the lease liability, as it would in case of concessions, the right of use asset will also be decreased by the same amount. The following entry would be made in such a scenario: debit the lease liability and create the right of use asset by the amount of change in the lease liability due to reassessment. And that's it. In computing the revised lease liability, the original or unchanged discount rate would be used. There is an exception for using unchanged discount rate, however, in the Type 1 reassessment. That is, when the revision in lease payment results from a change in floating interest rates. In that case, the lessee shall use a revised discount rate that reflects the change in the interest rate. And that's all for Type 1 reassessments. The other type of reassessment, which we shall call Type 2 reassessment, can be regarded as more substantial. That is, when we reassess whether a lessee would exercise an option to terminate a lease before the stipulated lease term, or would exercise an option to extend the lease beyond the normal lease term. So this time, the lease term is either being contracted or extended by an option that was granted to the lessee in the original terms of the lease contract, which means that the lease contract is designed intrinsically in a way that the lessee has more than one pathways in regard to its lease payments in the future. Alternatively, Type 2 reassessment could be when a lessee reassesses whether he would exercise an option to purchase the leased asset. Purchasing a lease asset would also affect either the lease term, in case the purchase option is in the middle of the lease term, or at least would affect the lease payments to be made because of the purchase. If a lease contract provides several options or paths for the lessee, then obviously the lessee would have to make a judgment as to which option is the lessee reasonably certain to exercise. As the lease goes on, the circumstances may change and the lessee's judgment of the virtually certain option may change. Remember, however, to be considered a reassessment, all these options should be in the original terms of the contract. In case of a type 2 reassessment, the lease liability would be remeasured using the revised lease payments under the revised option, and this time using a revised discount rate. This revised rate should ideally be the interest rate implicit in the lease for the remainder of the lease term. However, if the rate is not readily determinable, the lessee would use the lessee's incremental borrowing rate of interest on the date of reassessment. Either of those rates, whichever is used, should be the rate on the date of reassessment. The effective difference between the carrying value of lease liability and the remeasured liability would be accounted for in exactly the same way as type 1 reassessment. That is, debit the lease liability and credit the right of use asset. Lessee's determination regarding which path he is reasonably certain to take may change with change in circumstances, as we just discussed. But there is a category of change in circumstances which may make it reasonably certain that the lessee will take a path other than the one on which the original determination of lease term is based. And yet, in those circumstances, the change will not comprise a reassessment. This applies specifically to termination and execution options, but not to the purchase option. If a significant change in circumstances is beyond the control of the lessee, then the lessee does not need to reassess, even if the change in circumstances determining which option path the lessee is reasonably certain to take. So, if simply because of the pandemic it became reasonably certain that the lessee will exercise the termination option as soon as possible, this does not require a reassessment in the light of IFRS 16, because the pandemic is out of control of the lessee. In such a case, the lessee would compute the present value effect of the revised lease payments and reduce the lease liability by that amount, just like before. However, this time, the corresponding effect in this case would not be to reduce the right of use asset, but in profit and loss account. The right of use asset should be independently tested for impairment in this case. It is also important to note that all such changes to termination or extension options may not be out of control of lessee. For example, if a lessee proactively adjusts his commercial strategy due to the spreading pandemic, if due to change in the lessee's commercial strategy, the reasonably certain options change, such change will be considered a reassessment and will be accounted for accordingly. Lastly, if an event contractually obliges or prohibits the lessee to exercise an option not previously included in the entity's determination of the lease term, then such change in determination would be a reassessment, even if the event was out of control of the lessee in this case, because the event as well as the obligation was stipulated in the original terms of the contract, and thus the determination of the lease term is based on specified terms of the contract and not on which option the lessee is reasonably certain to choose.